Good morning, everyone, and welcome to the morning market review. It's Friday and it's the 29th of September. My name is Russell Shaw. I'm a senior market specialist at FXCM. I want to just draw your attention to my email address, rshaw@fxcm.com. And of course, if you need to contact me, that's the address to use. Let's go ahead and bring up our disclaimers. We'll start off with the high risk investment warning. I'll keep this on screen for a few moments. Thank you very much for joining this morning. It's much appreciated. Good morning, Kim, Rose, James. Pleasure to have you on the webinar as always. Hey, Matthijs. Welcome. Let's just go ahead, bring up the market commentaries disclaimer. All right, and just finally, our references MarketScope 2.0 and TradingView. And what we'll do is we shall start off with TradingView, and we will consult the real yield. This is really where we've been starting our analysis. And we did see that the real yield was overbought right here. And it's now pulled back, it's normalized. And at the same time, what's happened to yield? The yield has pulled back. I'm just going to highlight the border. Let's make it green, yeah. All right, so we can see that there is a normalization here. And we did say, well, there's probably some sort of ceiling in place because of that overbought condition. It's pulling back now quite notably. Another perspective, okay, is of course the weekly perspective. It's also overbought weekly. So the daily we've seen some sort of pullback, but the weekly still has some froth to it that I think has to work itself out. The difference between the two is that the weekly is quite difficult in terms of timing. It can take a few weeks to actually unwind. So we'll keep monitoring it. The idea here, of course, is that the yields are a key driver of the markets. And what we can do is just go ahead and take a look at the US dollar. And let's go through to the US dollar daily, because we did spot that it was overbought as well earlier in the week, and it's now correct. If we just take a look at this on a weekly basis, okay. All right, the RSI in normal levels. Let's just go back to the daily, and it's pulling back. The candlestick that we have for the dollar as we come to the last day of trade is a gravestone doji. It's going to be very interesting to see how the dollar ends for the week. Right now, what we have, just to show you, if we put in a set of axes here, and we got, say, Monday to Thursday, because we don't have the price action for Friday yet. What's happened is that there was it opened, went slightly down, pushed up to the peak of the week, and then as the yield started correcting, it's pushed back here. And we're just going to have to see how this ends for Friday. Right now, it looks as if the bulls have lost control, and I think the reason that the bulls have potentially lost control, there's a recognition that the yields were overbought, and not only was there a recognition that the yields were overbought, there's now profit taking. Whoever has gone into the US dollar recognizes that that overbought condition introduces heightened risk. May as well take our money off the table, right? Because we're in profit. And I think we're seeing some profit taking here, just as the yields correct. Now, there's something that's worth mentioning. I don't have the answer to it. And of course, we posed this question yesterday: is how much higher can yields go? Okay. The Fed has a narrative. That narrative is higher for longer. Typically, there is a cycle in the market. There's two cycles. There's the value cycle and there's the growth cycle. I want to specifically look at the value cycle today, and you'll see why in a moment. I'm just going to bring Microsoft Paint up, and the value cycle tends to move like this. We've got an accumulation, then we have a markup phase, then we have a distribution, then we have markdown, then we have accumulation. It tends to cycle, almost sort of like a digital type of pattern. And if we have to put in the labels, it would be sort of accumulation, you would have a markup. This would go into distribution. You go back into markdown. You go back into accumulation. And back into markup, etc., etc. Okay, so that's basically what we call the value cycle, where the accumulation suggests that there is value in whatever instrument you're looking at. Okay, so now we want to go back to the question that I posed: just how much higher can yields go? And it really depends on the bond market. What do market participants do with the bonds? At the moment, we've got really high yields. But if we've got high yields, it means prices have been absolutely flattened, because there's an inverse correlation between yields and prices in the bond market. And one of the ways we can look at it, there is an ETF called IEF. So I'm just going to show you IEF. And it's an iShares 7 to 10 years treasury bond. So instead of looking at bonds in terms of yield, we're looking at them in terms of price. And take a look. So we've got here this area here. According to the digital model, not the digital model, I beg your pardon. According to the value model, which looks digital in nature, this would be your distribution. This would be your distribution. Okay, then you've got a markdown phase here, don't you? Let's make this a little bit thicker. So it goes from distribution through to markdown. And you can see we've gone over. Okay. And if you take a look at this on a weekly basis, okay, we tend towards oversold. You can actually see how severe, here's a bigger distribution pattern, here's a bigger markdown, right? But if you are a bond investor, you've got to be thinking, gee, there's value here. And if there is value, okay, you kind of be licking our chops, thinking, where can I enter? Where can I enter? And what we can do is let's actually go to the weekly. What we can do to monitor this is go through to the weekly. And what we should do here is let's add in a 30-week exponential moving average, okay? And we'll use that as a timing mechanism. So let's go through to indicators, go through to exponential moving average, and just change this to a 30-week. Okay. Which one's this? Okay. And what I would suggest is that kind of here is distribution, here is the markdown, and I think when the candlestick climbs above the 30-week exponential moving average, perhaps some sort of a conclusion of an accumulation, or we're going through an accumulation. And if we're going through an accumulation, okay, then we would typically see bond prices moving up. If bond prices move up, yields should start coming down. So this is just an extra tool that we can use to monitor the yields. Bond prices move up, yields come down. If yields come down, one would expect then the dollar would face the headwind. At the moment, the dollar's got the tailwind behind it. And if the dollar starts facing the headwind, then the risk assets potentially have the tailwind behind them. You can, by the way, what we can do is we can just take a look at the 10-year yield underneath this. So just put in US 10-year, put it underneath. We're looking at it on a nominal basis, and you can just see how they move in an opposite direction. As the prices, so here's price moving sort of sideways to the downside, here's moving sideways to the upside, here's the mark down phase, here's the mark up phase, okay, and then of course you have the push down over there, you have the push up over there. So you can see the prices are inverse to the yield. So now we've got to think, what are bond market participants going to do? Are they going to start accumulating? And if they start accumulating, I would think that we're pretty near the apex of our yields. That's a big statement to make, by the way. So we've just got to see if that is the case. We're going to monitor this, of course, daily. Let's go back to our main layout, and what we can do is we can just take a look at US dollar. Here's a pullback, and you can see that on the daily basis, dollar really under the cosh at the moment. It is in the lower quintile. As long as it stays in the lower quintile, there's going to be a pressure there. S2 would be the next logical level of support, but definitely seems that as that overbought condition, remember we spotted that overbought condition on the yields, we spotted the overbought condition on the US dollar, and the suggestion there that there has to be some sort of normalization. It looks like we're in the midst of that normalization. So dollar under pressure. If dollar is under pressure, let's just take a look at euro. Okay, can say euro's got a bid to it. And this is the unwinding of that overbought condition on the yield. Okay, let's just take a look at two more. Let's take a look at pound. and then we'll take a look at dollar. Let's take a look at 3 more, and we'll just take a look at the DAX just to see how it's looking on the market open. Okay. Does everybody, just while the chart's coming up, does everyone understand the interaction between bond prices and bond yields? Okay. If there's any questions there, let me know. Okay, good. But this is taking its time. Let's just, there we go. Here you can see that, okay, pound moving into its upper quintile. The longer it stays in that upper quintile, the longer it stays there, the more momentum there is. The more momentum there is, okay, in the pound US dollar. Let's just take a look at gold. Right. Interestingly, gold lagging a bit here. It's got to get to this level. There is a potential bullish cross there, and there's a bullish cross there. All right, just the very more bonds for sale, lower yield. That's not quite the way that it works, James. Just send me an email. I'll give you some information on how it works. Not more bonds for sale. You can think about it this way. I'll show you a very basic explanation. It's not the true explanation, but you can think about it like this in terms of a bond. So basically, let's put a just trying to remember the math here. If you've got a bond that pays a coupon of $10 and it's worth 100, okay, then your yield is going to be 10%. Okay, the coupon never changes. So let's say the price goes down to 90. Okay, I'm just going to throw that into my calculator. Then your yield's going to go to 11.1%. So you can see price has moved from 100 to 90. Price has moved down. What's happened to the yield? The yield's moved up. So that's the mathematics behind it. It's not the best way to look at it, but for our purposes, it will suffice. All right, let's just take a look at DAX to see how DAX opens. Okay, and okay, so DAX still under pressure, but today, as the yields, remember the yields are in the midst of normalizing. We've still got that overbought condition on the weekly. It does look as if there is going to be a risk on day. Okay, so just keep an eye on those moving averages. Make sure that the green moving average stays above the orange moving average, and that the stochastic stays above 80. And as long as that those conditions hold, there should be risk on in the day. What's happening in the market? What's the driver at the moment? We spotted that overbought condition in the real yield. It's now normalizing. We just got to wait for that normalization to conclude and then reassess. All right, that's as far as we go this morning. If there's any questions, go ahead and type those through. All right, nothing coming through. Let us conclude at this point. Thank you very much for this. I think this is the dip, Raj. Yeah. The question, of course, is how high? This is the key question. How high can yields go? Are we at the apex? I don't know the answer to that, Raj. I think we're going to have to monitor the IEF exchange traded fund to help us get some sort of idea of what bond market participants are doing. All right, guys, let's wrap up here. Thank you very much. Have a really good weekend, and we shall chat come Monday morning. Thanks very much, guys.